So again, people who have been watching recording and people who have been attending live, I feel that you would have got some insights, at least got started with your journey when it comes to personal finance. So first week, we covered budgeting and emergency funds. Second week, we covered insurances. Third week, we covered the goals and why you should have financial goals at first place and don't invest just by, some random number on in random asset classes. So till now, we have got our basics right. This week, we'll be talking more about the asset classes and what is an asset allocation as such. But before you know what is an asset allocation, you need to know your risk profile also, because if you don't have that risk profile with you, you won't be able to decide on which asset class you need to invest in, right? So what we'll do is we'll quickly go through the basics for next 30 to 40 minutes. And in the last 15-20 minutes, let's stay back for the risk profiler, because I think that is more important. Because since you know the insurance requirement, your budget, your financial goals, I'm assuming. So now you need to know your risk profile also, because if you don't know your risk profile, then I think understanding asset allocation is of no use. So just stay back till the end. We'll try to conclude session ASAP so that we are able to do the risk profiling exercise as well. And you would get to know yourself better, because many of you mentioned that I'm a moderate investor, aggressive, conservative. That might not be the case. And I'll speak out some facts when I share my risk profile and my investment portfolio as of now. So it is completely contradictory in nature. And I'll explain how once we go at the end of the session, right? So everyone started, everyone ready for the beginning? And if you can just mention quick BIOs and show some energy in the chat box so that we can get started right now. And
Yes,
friends, keep the super. And please keep the energy high, friends. I know that it's a Tuesday, and I think Rushabh mentioned that Tuesdays are a bit long for sure, because Mondays में तो कितना काम होता है उसमें पता ही नहीं चलता कि time कहाँ चला गया. But Tuesdays are obviously a bit slow now. Slowly, I'm also realizing. So we'll keep the energy high for the next 1 hour, and we'll have a good discussion, friends. Let me tell you, you'll learn quite a lot of things in this session. So let's get started. Thank you so much, everyone. Rushabh, Arpit, Sagar, Sanjana. Good to see you all for all the live sessions. So, friends, we have moved slowly and gradually to this session. And let me tell you that if you don't know what are the asset classes, then again, you might be missing quite a lot, because now when you know your financial goals, you need to practically invest for that goals, right? So we'll quickly get started with asset allocation and asset classes. But before that, just remember this thing, that successful investing is all about managing risk and not avoiding it, because you cannot avoid risk when it comes to investing. You just have to manage it. So just understand the difference between the managing and avoiding. We try to avoid it, or we think that we can avoid it, but practically that's not the case. You have to manage the risk always. You don't have to avoid it, because there is always an inherent risk whenever it comes to any of the asset classes. So if you feel that ki debt instruments be safe hote hain, so then friends, you are absolutely wrong. There is some interest rate risk also when it comes to debt instruments. So we'll not go what is interest rate risk, but let me tell you that debt instruments are also fluctuating in nature, and that is also not completely risk free. So risk is always there whenever it comes to any of the asset classes. And when we speak what is an asset, so what does it exactly mean? Because since we'll be studying about asset classes and asset allocation, so it was pretty much clear that we should have the definition right. So assume that you have one share of Reliance Industries, right? So a asset is a resource with a monetary value that a person, business, or a country owns, with the expectation that it will bring benefits into the future. So let's say if you buy a Reliance Industry ka share, so you would expect two things: either the capital appreciation or the dividend, right? So these are nothing but the benefits that you expect from an asset. Or let's say when you buy a bond or any fixed income instrument, let's say FDs, so you expect two things. First is obviously your interest, which you'll get quarterly, monthly, yearly, and your principal amount, right? So you have some monetary benefits attached to it, and something which can give you a cash inflow or cash flow, positive cash flow going forward. So that is nothing but an asset. So if you're buying a house, you are expecting a rent and also the price appreciation, right? So that is nothing but an asset. So asset is nothing but a instrument which will give you some cash flow going forward. It can be maybe after 1 year, 2 year, 5 years. So this is a simple definition of an asset, right? So I need to clear the basics now because we don't want to rush in and directly understand what is asset allocation, but we need to understand what is an asset, right? So this was a quick definition about asset. And friends, whenever we do any investment, right? So what all we expect? First is saving tax because there are some tax saving instruments as well, right? So can you all mention what are some tax saving instruments? If you know any of it, or if you don't know, then you can always mention IDK. I don't know. But if you know some of the tax saving instruments, maybe if you can mention it very quickly in the chat box. PPF is one of them.
Yeah,
जो
insurance,
ATC,
life insurance.
life insurance, ATC, HRA. HRA is not an investment. Health insurance is not an investment. NPS is an investment. Yes, correct.
And yes.
Gold bonds.
Okay. ELSS, yeah, super. SIP is not an investment, a tax saving investment. It's not a tax saving investment. EPF is a tax saving investment. Super. Yes, gold bonds. Some FDs, yeah, tax saving FDs as well. Yeah. So friends, these are few of the things that we expect from investments. That is first is saving tax many of the times. And second is secured investment. मतलब you don't want to be thinking कि आज मैंने पैसा डाला कि मुझे मेरा प्रिंसिपल मिलेगा या नहीं, right? So it has to be a secured investment as well, and obviously it has to be liquid in nature. Like whenever you need money, it should be available at a short period of time. And then ultimately some kind of an assured return, not assured returns, but some kind of returns that you can expect out of an asset, right? So this is nothing but what you expect from an investment, right? So just setting the basics, right? So that we move slowly and in a very positive way. So various asset classes. So friends, we'll be studying asset classes for next 10-15 minutes. So cash, bonds, real estate, stocks, precious metal, be it gold, silver, and deposit. These are kind of some of the asset classes that we all have heard or seen, right? So first is obviously your stocks. So how many of you have been watching Shark Tank, or you have watched Shark Tank, let's say 2-3 episodes? I'm expecting that most of you would have watched Shark Tank or would be watching Shark Tank, right? So you get to hear about these two terms, equity and debt. Equity
Yes.
and debt, we all have been hearing equity and debt, right? So I'm pretty sure that you know that what is an equity and what is a debt. So what we'll do is we'll quickly understand from the example of the Shark Tank point of view, right? So let's say you have gone there as a new startup. So definition of equity is very simple, that you are the owner of the business and you are selling your stake, right? And the risk is very high because you don't know, because that's a business and you are becoming the owner of the business. So it can be any percentage. It can be 0.1%, it can be 1%, it can be 50%. But once you become the owner, so your risk is high, your return is high always. Do you all agree, friends? If you have opened up your business, then your risk is high, return is high, right? And liquidity is also high. So we are talking more of, equity markets as such, जहाँ पे you purchase mutual funds or let's say buy stocks in your Demat account. So liquidity is very high. You can sell and buy at any point of time from between 9:15 to 3:30, right? And ideal uh, holding period is long to very long. So I'll just clarify one thing before we move forward. So I'm not talking about trading. I'm talking about investments which are long term in nature. So I'm not an expert when it comes to trading. So if you're here for some trading tips, then I'm sorry, Fred, I won't be able to help you out. We are talking about investments, something that creates wealth. We are talking about wealth creation and not trading, day trading, right? So ideal holding period of equity is usually high because the risk is high and there is quite of volatility in nature. So these are some characteristics of equity, and these are some instruments about equity or let's say popular investment avenue. So stock market is one of them where you invest directly through your Demat account, mutual funds, ETFs, PMS, and ULIPs. So as of now, if you have not understood ETFs, PMS, and ULIPs, that is absolutely fine. PMS is just to let you know, it's a 50 lakh product. You need at least 50 lakh of investment to invest in PMS. So let's forget about that. ETFs is nothing but a replica of an index. Sensex or Nifty ka, Sensex or Nifty hai. These are market indices. So let's say if you want to buy the whole market or whole index or whatever constituents are there in that, you buy an ETF and you can buy through a demat account. Keeping it very simple, not going in detail. And ULIPs is nothing but your insurance and investment combined. So when you invest some amount of money through your insurance premium, and these are getting invested into stock market, this is nothing but a ULIP policy. So we studied about term policy, but there is a different kind of insurance policy as well, which is called as ULIPs, which invest in your stock market, right? So these are some popular avenues of equity. And now let's move on to bonds and fixed income. So have you heard, sharks offering loan to the startup founders at 10% rate, 12% rate, right? So that simply means that they are providing, let's say, 50 lakh in equity and 40 lakh via debt at an interest rate of 10%, 12%, right? So we'll take a look at this from that viewpoint. So definition is very simple: lending money with the expectation of return of capital with interest. Risk is very low because you are getting the fixed return of amount. And friends, let me ask you, let's say company is liquidating, who would get the money first, equity holders or debt holders?
Debt holders.
Debt holders. Okay, debt holders, right? So risk is very low because you are getting the fixed interest as well. Let's say 8%, 9%, and you get the preference as well. Let's say if company is liquidating, the debt holders would be paid up earlier because they are the creditors for the company. And since you are the owner, you would get your money at last. So risk is very low. Return is low to moderate, I would say. And liquidity is again low to moderate depending on the instruments. And ideal holding period is short to medium term, because you can invest for 3 years also and get a fixed return, and then you can wind up your investments also. But equity, this is not the case. You might have to wait for quite a lot of years just to get the returns out of it. So debt is primarily a bit safe when as compared to equity. And some of the instruments through which you can invest in debt products is very simple: debt mutual funds, PPF and EPF, because since they invest quite a lot of money in fixed instruments, so indirectly you invest in fixed instruments only when you invest in these products. And you have your post office savings schemes, bank FD, and P2P lending. So P2P lending, how many of you have heard of it? P2P lending. I'm pretty much sure that you would have heard of these schemes: PPF, EPF, bank FD, debt mutual funds. Yeah. P2P is nothing but peer-to-peer lending. There is a platform, uh, quite a lot of them. So what they do is they lend money to a person who needs it and a person who is ready to give that money. So they pool your amount and give it to these, your peers, and at a good, decent interest rate. Usually it is higher than FDs for sure. But again, risk is quite more because, these are the people who might not be getting credit from elsewhere. So that's why they have come to P2P lending. So this is a bit risky for sure. But yeah, so this is kind of a, debt instruments where you can invest and get some fixed returns out of it, right? Hope it's going good as of now. And then we move on to the real estate. So we Indians have been loving buying the real estate, and we always think that ये तो हमारे retirement का खजाना है. Meaning that we'll buy a good one or two properties and then we'll get some good rent out of it. But pretty much that we all know that rental yield has quite less as of now, but we'll not go into technical things. But yeah, real estate is a bit of a high ticket product, high on emotion, considered safe for sure, because at least you get some rent and you get small bits of appreciation every year, or let's say every 2, 3 years. And it's a high ticket size product, friends. We need to invest at least lump sum 20 lakhs, 50 lakhs, 1 CR to invest in the real estate, and then high prevalence of cash in transaction. Liquidity is very low. So how many of you agree with this? Because if you want to, let's say, sell a house tomorrow or day after, you won't be able to sell it tomorrow or day after. अगर आपको बेचना बेचना है तो आपको दाम तोड़ के बेचना पड़ेगा. You have to sell it at a lower price, right? So liquidity is very low in these products, this product specifically, and the risk is medium to high, I would say, because again, if you're not able to sell a property, or let's say if anything happens to your specific project, then the risk is very high to the real estate investment. So I feel the risk is always medium to high in this case, and return is also low to high. It really depends on which property you are buying. And let's say if that property is not good, so returns are always, nearing around 5, 6%, 7%, which is again, which any FD can also give it to you. And these are some popular real estate investment avenues: house, apartment, commercial property, where you, let it out to any of the businesses, plot and farm, and then REITs also. So REITs is some kind of a new product that has come to the market very recently. So what you can do is, this is a small ticket size product and you can buy it from the stock market also. And this is being traded, friends. So you can buy small bits of real estate kind of properties which will appreciate in price. So this is a low ticket entry, let's say 1,000, 2,000, 5,000, and it can give you some decent returns. So if you want to do some small fractional investing into real estate, so REITs is, I think, one of the good products which you can start looking to. Apart from that, every product has a high ticket size at the entry. And then we talk about commodity. I was about to say community, but sorry, commodities. So commodities, we usually talk about gold, because many of us believe that gold has been good investment and it can be used further as well. हमारी शादियों में भी use सकता है. And then our parents tend to buy it because they think we can give it to our any of the parties when our child is getting married. So traditional mode of investment, I think, considered safe for sure, because gold has been at least increasing at the rate of inflation. And liquidity, it's good. It's high, I would say, because you can quickly get a gold loan, or let's say you can quickly sell a gold jewelry as well, or whatever it is. So liquidity is very high. Risk is, I think, the storage part, because maybe you have to keep it safe when it comes to physical investments. And return is low to moderate, I would say, because sometimes when the markets are performing good, the returns on gold is a bit less. And then it goes up to the moderate thing. And gold investment avenues. So physical gold, obviously you can buy, and you can buy gold ETFs as well, and sovereign gold bonds. So I'll just quickly mention what is a gold ETF. So again, you can buy it through a stock exchange. It has a specific price, and it will move according to the gold prices moving up and down. So it's a small ticket size product, let's say 400, 500,000 rupees. And once you buy that, as and when your gold prices would increase, this ETF price would also increase. And sovereign gold bond is nothing but a kind of a bond, a fixed income instruments, which if you held for 8 years, start to end, uh, it will move according to the gold prices, and yearly you will also get 2.5% interest. So let's say if you want to invest in a gold but don't want to buy a physical gold, right? So what you do is, you buy 100 rupees gold bond today once it's issued, and it has a maturity of 8 years. So जब 8 साल के बाद उसका price चल रहा होगा gold का, you would get that amount. Also, you will be getting 2.5% interest every year. Right? So if you want to invest in gold, I think SGP is one of the best ways to invest in gold, because you get 2.5% ka interest as well. In the gold ETF, it only moves according to the gold prices. So let's say 100 ka 200 hua, you get that specific amount. But in gold SGB, which is sovereign gold bonds, you get the capital appreciation and also the interest amount in between. So, and it is also tax free if you hold it for 8 years. So I think one of the good investment if you want to start investing in gold a bit. Yeah. And then we have the cash and gold, sorry, cash and liquid, which is nothing but your liquid investments. So nothing to be explained here. So which is the most volatile asset class, friends? I think crypto, but yeah, as of now for the discussion, we'll keep it equities for sure. So mostly equities, because these are long-term instruments and it has a lot of volatility and risk as well. So hence they are more volatile assets. So what is asset allocation. But friends, before we move on to this, any quick thing that you did not understand from asset classes, and then we move on to the asset allocation, because this is very important. Anything that you did not understand from the earlier topic? Are we all clear with the asset classes as such? We discussed four major asset classes: equity, debt, commodities, and real estate, and cash and liquid for sure, which you all know.
There's been one question probably from my side. I've never like really explored commodities as much, right? You or anybody else, I don't know, who have tried out commodities, how has your experience been, right? Is it like because usually people have who have no usually swing trade on commodities, do not
Yes.
invest from a very long term period. So how has your experience? Anybody who has invested in commodities, their experience been?
Yeah, so usually, people do trading in commodities, but when it comes to investment, I've seen people investing in mostly the gold or silver as such. So we were talking from that viewpoint, but I think trading in commodities is again very volatile, and it is based on the geopolitical things, and you need to be knowing quite a lot of stuffs if you want to trade in commodities. So yeah. So investing point of view, gold and silver has been one of the top contributors.
But I think things like oil and some of the um, I think cereals and things like that are also that something that people
Trade.
investors common trade. Okay.
Yeah, but
So people trade in them.
Sagar, trading and investing is both different
Yeah, of
commodity
course.
classes.
Of course. I was trying to understand if there's an investment opportunity in commodities as well. So like for things like oil or those things, like on a long-term basis, they are also ultimately increasing only, right?
You, but for commodity trading, you don't have long-term windows. It's usually a 30-day, 45-day cycle where you need to
Okay.
roll back your investment, and based on that,
Futures
you
and
get the
options.
returns. It's FNOs basically.
Right.
Now FNO has become
Correct.
separate and commodities. It's a different class of thing. You need to be constantly on it.
Got it.
What Dipin is talking about, just buy and keep and kind of things, commodities.
Correct.
Makes sense.
Correct. Yeah. So we'll quickly move on to what is asset allocation. So, so simple definition of asset allocation is nothing but your wellness thali. So we all have been, becoming health conscious, definitely after COVID. So do you all prefer having carbs, proteins, fiber, and fats in an ideal meal? Or let's say in a day or so, you would definitely love to have some proteins, carbohydrates, some high fat, and some fiber as well. Split allocation across all the assets. Yes, yes, Neha. I think you're getting it absolutely right. So that is nothing but your asset allocation. So I'll quickly show you what is an asset allocation exactly. So this is nothing but your portfolio being divided into different kinds of asset classes. So we understood what is an asset class and what are the different types of asset class. So asset allocation is nothing but dividing your portfolio into separate asset classes according to your risk profile and your financial goals, right? Super. Okay, so now, friends, this is very important, and I won't show you this slide because we need to be, understanding this concept very properly. So, uh, we have been using asset allocation and diversification very interchangeably. Do you feel that there is a difference between that asset allocation and diversification? We always use it interchangeably कि हाँ यार मैंने अपना portfolio diversify किया हुआ है, or I have, like, let's say, done good asset allocation for my portfolio. So what is your take on that? Is it the same or is it different? Okay, different. Okay, and I'll show you what is the difference between asset allocation and diversification.
So I think asset allocation is one form of diversification, right? Like where you are diversifying across assets. Like diversification is like a superset, right? You can also diversify within the same asset.
I had
Absolutely.
something different in mind, but maybe
Uh-huh.
I'm wrong. I
Please,
thought
please go ahead.
allocation is how much you're putting where, and diversification is just putting it in different places, but might be wrong.
Daily. So no issues. We'll see
So,
what is the difference between yes or Rushan.
yeah,
And
my understanding on diversification is like spreading your risk across different asset class.
So that is asset allocation.
Asset allocation could be concentrated to one asset, but when you see diversification, we are spreading it across different asset classes.
Okay, so I'll explain it to you all. So asset allocation meaning you are dividing, let's say, 100 rupees portfolio into different asset classes. 60 rupees equity, 30 rupees debt, 10 rupees gold. But when you further diversify that 60 rupees into that particular asset class, that is nothing but diversification. So when I mentioned that 60% is in your equity, it can be anything. It can be equity mutual funds. It can be your direct stocks. It can be your, let's say, any of
assets.
ETFs also. Right? So आप जो asset class के अंदर divide करते हो, that is nothing but diversification. Let's say your 30 rupees was invested into debt instruments. So that can be your FDs, government bonds, EPF, PPF, and your corporate bonds. So this is nothing but diversification among the asset class. Are you all clear with this? What's the difference between asset allocation and diversification? So when you are diversifying within an asset class, this is known as diversification. So if I invest in multiple mutual funds, so if you're investing in multiple equity mutual funds, so then it is under the diversification of equity. And once you are doing that under the debt mutual fund, so it is considered diversification for debt. Are you all clear with this, friends? What's the difference between asset allocation and diversification? Yes, diversification is a subset of allocation. Absolutely right. Absolutely right. Super. So now we know the difference, and now we are not like the Janta. We know the difference between the asset allocation and diversification. So you can always talk about this in the next parties, wherever you are going to. Yeah. So investing in fixed deposits and government bonds is an asset allocation or what? Fixed deposits and government bonds is an asset allocation or what? Guys,
Are you asking is it the same asset or what?
so it is an asset allocation or diversification? That's what I'm asking. So no, it's diversification. It's a diversification amongst the debt instruments. So let's say if you have bought 30 rupees ka total debt, usme se some part is of FDs and some part is of government bonds, right? So that's a part of a diversification. And now we move on to benefits of asset allocation. So what, according to you, can be the benefits of asset allocation? Now, I'll definitely take you through the asset allocation benefits, but what, according to you, you guys feel that can be some of the benefits of asset allocation?
One is liquidity,
Liquidity, yes. Yeah.
short
Reduced
term
risk
and
is
long term.
yeah. Less risk, super. So friends, if you have understood this, the concepts till now, you would be able to answer this for sure. Less risk, yes, for sure. You would be dividing your risk.
Increased earnings.
Yes, returns optimization. Correct. Or increase in earnings. Correct. Saiti, Sai, Suma, less risk. Yeah, apart from risk, so I can say risk and returns for sure. Yeah, so let's move on to the benefits of asset allocation. So the first point is the most important one, reduces the investment risk, right? So you're not in. So how many of you have heard this, that don't put all your eggs in one basket? So this is nothing but your asset allocation thing. So don't put all your, let's say, investment. Acha, I have seen quite a lot of people investing all the money in crypto. Can you all believe it? Like, how can you invest all the money in crypto? Because you can invest 4, 5%, 7% of your investment, which you feel that you are okay to lose. So personally, for me, I have invested, let's say, 4, 5% of my portfolio into cryptos, or मैं तो भूल गया हूँ. I don't remember that my money exists in crypto. But people have been investing all their money in crypto, so you cannot put all eggs in one basket. And as we learned about the financial goals also last week, so you cannot invest in equity class for your home renovation, or let's say for your marriage, which is coming down, let's say after 1 year. So you cannot put all your eggs in one basket. You have to diversify amongst asset classes, because always returns is not the case. You have to look for other things as well, which we'll see in the uh, coming slides. So optimizes return for sure. So whenever, let's say so do you want to know how much percentage Sensex or Nifty fell in the March 2020 COVID times? It was almost 40-45%. So let's say if you had invested all your money in equities and you wanted your money back, so would you redeem at a 50% lower cost? And let's say if you'd have invested in FDs, 20-25% of portfolio, so at least you can withdraw from FD, right? Because you will get the principal amount, maybe you won't get the interest. So that's the importance of doing the proper asset allocation. It optimizes return. So at that time, you would have lost 50%, friends, if you would have withdrew the amount, but you did not withdraw the amount and you kept it as it was, and you, let's say, redeemed it after 2 years when the markets were 100% above, or whatever points they were at the March 2020. So it optimizes your return also. So don't feel that if I'm not investing in equity, I'm losing out on some returns. Know that when the times are not good, your debt instruments can help you quite a lot. So asset allocation optimizes returns. And third is helps in being attuned to your financial goals. So as I asked you that, would you invest in FDs for your retirement goals? Many of you said no. So it always helps you in your financial goals as well, because you need to know for which goal you need to invest in which asset class. And then fourth point is makes market timing irrelevant. How many of us love to just predict the markets that आज market बढ़ेगा, मैंने तो सोचा था 3 महीने बाद market बढ़ेगा. But if you are being disciplined in nature and if you're keeping the right asset allocation for the longer term goals, it really doesn't matter, because you cannot time the market. Even Warren Buffett cannot time the market, right? So just make sure that you cannot time the market, and the best use of asset allocation is to just invest it properly so that you're not redeeming the investments once it's gone 20% low or 30% low. And then the next point is addresses your liquidity concern as well. So if you're investing in equity or in some risky instrument, which you feel that I won't be able to have liquidity for 3 to 4 years, but I know that after that liquidity would be there. So by that, you invest in other instruments, liquid instruments, and you address your liquidity risk as well. So proper asset allocation helps you in that. And then last point, it helps you in your tax planning as well. So many of you mentioned that there is ELSS, PPF, EPF. So obviously you can consider that part of your investment into your asset allocation. And let's say if you have invested in ELSS, so that is nothing but your equity allocation, right? So it helps you in proper tax planning as well, the asset allocation and the benefits of it, right? So we are done with the asset allocation. So any such queries when it comes to asset allocation and benefits that it has? Yeah. And quickly, yeah. So let's move on to factors which determine the asset allocation. So very important. And if you read it out by yourself, I think you would be able to understand these topics. So first is your time horizon. So your time horizon will affect, or let's say predict, your asset allocation, because if your time horizon is quite, I would say, long term, so you would definitely prefer equity. So again, your preference would come based on your time horizon and your risk tolerance. But you feel that, boss, I won't be able to invest in equities because I feel that I cannot take that much of risk. So I would like to reduce my equity portion. Hence, your risk tolerance also affects quite a lot of your asset allocation and then your financial situation. Let's say you have good amount of money already for your financial goals. So where would you invest more? If you have your goals sorted for sure, let's say, so you would invest in more riskier assets or more investments where you have the chances of increasing more returns, but again, you have the risk as well. So it also depends on your financial situation as well, on what asset allocation you would prefer for your investment. So three very important things, friends: time horizon, risk tolerance, and financial situation. These three factors contribute quite a lot when it comes to deciding your asset allocation. Yeah. So now, how many of you have this question? We have understood about everything. We have understood about all the asset classes. Now, what is the best time to invest? Start of the month, end of the month, middle of the month. So, yeah. So this was a quick study which was done, and where, I think some study was done where it studied the 26 years of S&P BSE index. So let's say the BSE Sensex ka data, and they found no significant difference in the average returns of a 10-year SIP on different dates. Right? So आपने 10 साल के लिए SIP किया in BSE 30, Sensex 30, and the returns you can see 15.75, 15.76, 75, 76, 77, 75. So returns are same. So you don't need to think that which is the right day to start investing. You can start with your investment with any of the dates, and I think you would get the same returns. Because many of the people feel that investing early, or let's say in the first week, would give them low returns, but that's not the case. Yeah. And this is a very powerful image that I would like to explain. So let's say the investment return is 15%. But investor return is not always the 15% because you redeem in between, you panic, you don't invest when the markets are low, or you, let's say, redeem it because of some situation. So many of the times, and this was the case study which was done by Axis Mutual Fund as well. So when investment return is 15%, it's not at all a surety, or I would say not many of the investors get the same return, and there is a huge gap between the investment return and investor return, but that is nothing but your behavior gap. So this is according to your behavior on how you are, displaying your actions at that particular time, and which determines your returns and investment returns. Because we get fascinated by saying, yaar, ye SIP ne, let's say, ye mutual fund ne the 24%, 25% diya. But is it really the case when it comes to investors? No, boss, because I don't remember the exact numbers, but let me tell you that more than 50-70% people don't get the exact investment returns. They get the lower returns because of their behavior on what they display at the specific important times. And then this is nothing but a quick summary of what we studied. So asset allocation is nothing but your debt mutual funds, equity mutual funds, liquid real estate. You can avoid this thumb rule as of now. But how do you do asset allocation? By keeping time horizon, risk profile in mind, and the benefits of it is reducing risk, achieving your financial goals, and being in control of your financial wealth. And then these are some popular goals that we have, and how we can map these two different instruments that we have. So let's say your emergency fund should always be in liquid and debt funds. Your own marriage planning depends on the tenure, but it can be in equity and debt. Retirement planning, majorly equity. Home renovation depends equity. Debt sabbatical can be from debt. Car purchase, new venture, debt instruments. So these are some of the things, just a quick snapshot on how you can invest in the particular things. But yeah, so thank you very much. We are done with the session. So hope you all liked it. And my one quick question to you all is, let's say whatever amount you have saved till now, can you just divide that into different asset classes and mention that what percentage you have in equity, what percentage you have in gold, what percentage you have in debt? Any rough idea that you can give? So 100% equity. Okay, Rishabh. So for me, let me tell you that I'm an aggressive investor, which means that I can invest almost majority of my money in equities, but I am 60-40, 60% equity and 40% debt. Why is it so? You may ask that. Obviously, boss, you can invest in equities, then why you are investing in debt? It's because of my financial goals, which are nearby. So that's why I kept majority of my money in debt funds and liquid funds. So that's how having clear goal in picture can help you in asset allocation. How many of you agree with this, and how many of you understood this? I'm an aggressive investor, but my equity allocation is only 60% because my financial goals are nearby and I cannot invest in equity funds 100% because maybe once I need money after 3 months, I don't know where the market would be. So I'm preferring some safe instruments when it comes to my near-term goals. So Sai Suma says equity 40, gold 10, cash 5. So where's the other 45? Okay, Sagar says 75% equity, 10% debt, 5% gold, 10% in alternate asset classes. Rakesh 40, 40, 20. Currently 100% will be changing it up. Super. Harinder says 30, 30, 10, 10. Okay, Arpit 40, 40, rest in other asset classes. So friends, now what we'll do is in next 2 to 3 minutes, we'll check our risk profile also. Maybe it can be a bit high, it can be low according to your perception. I don't know, but I think you should always know your risk profile as well, right? So if any doubts, we can always go to a few of the question and then we can start the risk profile questionnaire in next 2 to 3 minutes. Okay, this will stay for long. This hits home. 45% on food and shoes. Good. So any questions, friends? I can see a lot of silence today. Any question as such from you guys? क्वेश्चन नहीं होते तो दो ही मतलब होता है आई फील, या तो सब कुछ समझ आ गया या कुछ नहीं समझ आया. So I'm expecting that you guys have understood everything.
But I mean, no questions, but a lot of personal experience of, like, not for me, but for my friends who I've seen have invested a lot of their hard-earned money in just one thing, right? And I've lost a lot of money, right? And then they regret it now. But yeah, so I think it's kind of important, whatever is your risk profile or whatever your goals, do not keep all your eggs in one basket, right? Very cliche, but very, very true. So do save some of your money. I think especially when we're talking in the first session also, right? Things like emergency fund and all of this is something you should not park in high risk asset classes, right?
Correct.
And keep it close. So some part of your portfolio should definitely be safe, secure. That can make sure that it can take care of your emergencies.
Correct.
Quick question regarding the debt instrument. So usually bonds have a high ticket size, whether it be it corporate bonds or government bonds. So how do we diversify our asset in the debt instruments, barring FD and RDs?
So debt mutual funds is a good option because in India, the bond market is not yet developed that much. And maybe you can go and buy it through RBI website, but I'm not sure about the liquidity and stuff. So I think debt mutual funds is a good option. And in debt mutual funds also, you have quite a lot of options. So corporate debt, you have your government bond, GSEC market, you have your liquid funds, you have ultra short-term bonds. So there is a lot of options available in debt funds also. So there is a credit risk fund as well, जो कि early stage companies or let's say mid-sized companies में invest करती है, where you get high interest around 11%, 12%. So that is a credit risk fund. As the name suggests, there is a credit risk into that fund. So I think debt mutual fund you get all the variety when it comes to the risk, the government bonds, corporate bonds, everything. So debt mutual fund is a good option and good way to go.
There's a new one also, bill discounting funds.
Bill discounting, yeah.
That is a slightly higher risk.
Not really when it's pooled.
Yeah.
And
Yeah,
again, you have
otherwise
to
can
check,
still be
you have to
defaulted.
research the companies that you're giving your funds to. PSUs and large MNCs usually don't tend to default on their payments. It's just a slightly medium term funds.
And I think for me, like blue chip corporate bonds have been pretty safe and have given decent return. So you can like explore
Yes,
any debt mutual fund that invests in blue chip bonds.
It's
You'll
it's
exactly.
also it's also again like this, right? Some funds work for some people, and we just purely can't go by number. We have to experiment slightly in some places.
I think specifically from this all setup, the idea is to get an understanding of how to think about it, right? I think there are a lot of nuances into picking specific funds or specific
Yeah.
stocks, which is a little out of scope. But yeah, I hope that we are able to develop a thought process, like how do we have to go ahead and approach it. In
Sure.
fact, I have opened the risk profile question and I'm already curious, Dipin.
Sure. So friends, what we'll do is hope you have downloaded the risk profile tool that I've sent in the chat box. So it will look something like this. So what we'll do is we'll just quickly assess our personality in next 5 to 7 minutes. And then I would request you to please share your score and your risk profile so that you'll be able to see below once you are done with the questionnaire. So it's a very simple questionnaire and the importance of this questionnaire is very simple. Sometimes what I have seen people is they are not that much risk-taking investors, but still they want to invest in equities and then they lose their sleep just thinking that what returns my equity would give when it comes to let's say 1 year or 3 year. First of all, they have not understood the concept very clearly and when to invest in equities and how long you should stay invested in equities. And also they don't have the proper risk-taking capacity also when it comes to taking different investing in equity or let's say debt, right? So we don't have to feel guilty about it that we don't invest in equities or let's say if you have over invested in equities or any of the risky instruments. The only thing is to know the risk profile and then start thinking how we can start changing our portfolio and how we can manage the risk in a better way, right? So we'll do a quick questionnaire. You just have to mention like this: A, or let's say B, C, D. Whatever you feel like after reading the question, please mention A, B, C, D, and at last you would be able to see a score. But please complete all the 20 questions in next 3 to 4 minutes, and then let's see who is the aggressive investor, conservative investor, or the moderate investor, right? So I'll do it for my own, and maybe you can also all do it and share your quick answers or numbers in the chat box. I just did it right now, so I'll share my score once we are done with this. It's a very interesting activity and it won't take more than 5 minutes, friends. That's my promise. But you would definitely get to know your risk profile because if you don't know your risk profile, then you won't be able to invest properly into different assets.
Also, guys, having a high risk profile is not necessarily a good thing, right? I don't know. Sometimes people feel
Yes.
like if you are a conservative investor, you can still make a lot of money, right? So just try to answer honestly for yourself, even if you do not want to share it on the chat. But you do not necessarily have to be a high risk taker.
Yes, absolutely. So many of you mentioned that you are aggressive, conservative, and moderate. Just see if it's matching your uh, answer that you had put in the poll today evening.
Hey, Dipin, can you please share the questionnaire once?
Yeah, sure. Sagar, can you share it once? I've opened the file.
Just a second.
And once you are done, you can share in the chat box as well what's your risk profile score.
Oh, I will share it again in the Zoom chat.
Sagar, are you done with this? What was your score?
No, I'm just left with last 2-3 questions.
Okay. Moderate investor, which is, I think, in between 351 to 500. Ansari, you can share the score as well. The exact score and then the category it is. Score is 430. Superb. Superb. So at least now you know that what kind of an investor you are and how much risk you can take. And then now you can start thinking that what asset classes you can prefer when it comes to investment. So you would kind of love to have some debt as well based on your risk profile.
So it's not showing up my score. Maybe something off with the sheet that I'm using.
Just see if you have mentioned all the things in small letters.
Oh yeah, got it. Got it.
Yeah. 480, Abhinav says, Arpit, 510, Rishabh says 560. Okay. So you'd be able to see some kind of a recommendation also, but this is not a recommendation for sure, just a quick guideline or suggestion when it comes to on your score. 510, Tulasi, Sagar 620, Rushabh says 560, Arpit says 510, 480 moderate. Yeah, super.
We have some risk takers in the community.
Absolutely. 590 says Pragya. Good.
If honestly,
Yeah.
if I was asked, I would have said myself as conservative. But
Sorry, you have invested all your money in equity and now you say you are a conservative investor.
not so. Sorry, I forgot to mention. There's some PPF also.
Mhm.
But in terms of what I've invested in equity, also it's not a very large sum.
Okay.
So I don't go very aggressive with equity investment as well. Like I would say as this thing because all the other savings is there, so I am not worried about the funds that I'm putting in equity, right? All my
Which is, I
expenses
think,
are taken care.
which is
So
good.
yeah, from
Right.
that point of view, I would say that I'm conservative, that I don't need to worry about that long term. At least that's what I thought till now.
Mhm.
I think within equity also there is varied risk, right? In different
Hmm.
type of equities. So even though my majority of investments are into equity, but within equity, majority of them are still into blue chips, right? Where of
Hmm.
course there is risk, but are
Lower risk is
comparatively
there.
safer.
Diversified risk.
Yeah,
Yep.
yeah,
Not as much risk as the small caps, I would say.
yeah.
Cool. So I think my score is around 700. So that, and that increases based on the understanding that you have of the markets also, because there were 2-3 questions which were specifically mentioning about the knowledge as such. But I think slowly and steadily, as and when you start learning more about it, you would definitely see your score improving also. But again, to each his own. Nothing is there to comparison for sure. We just need to know our risk profile so that we are better aware that where which asset class we can invest into. So that was the purpose of risk profiler. So friends, now we are done with all the 4 weeks, the formal thing that we promised to you all. And if you can maybe quickly come online and say, let's say, mention your feedbacks, or if you have anything that you have learned from today's session, or